My name is Paul Rossano, and today we're going to be talking about the Wealthy Code, the formula for structuring passive income deals like the top 1% of investors in the world. I'm here today with my colleague, George Antone. And George, are you there?
I'm here. How are you, Paul?
I'm doing great, George. How are you?
I'm excited about sharing this information with everyone here, and I see we have a lot of callers here, so I'm pretty excited. In fact, I know whenever we share this in live settings, we get a lot of excitement, and so I'm pretty excited about doing this as a webinar.
Excellent. I'm excited too. So, George, with that, why don't you go ahead and take it from here?
Excellent. Welcome, everyone, and we're going to jump into this right away. So I want to start with a fact. Over 90% of investors get involved with investing for passive income. Now, we've all read books like Rich Dad, Poor Dad that really got us into passive income and thinking about passive income. And it turns out well over 90% get into that. So our objective for the presentation today is to open your eyes to the formula for generating passive income without dependency on any specific asset. Now, when I say that, without dependency on any specific asset, that means it's not specific to real estate, it's not specific to paper, it's not specific to private lending, it's not specific to any one asset. This works for any income-producing asset. Once again, any income-producing asset. So once again, to open your eyes to the formula for generating passive income without dependency on any specific asset that only the most sophisticated investors on the planet know. And we're going to be talking about this formula that you're going to find out applies to any income-producing asset. So let me start with this. When I say sophisticated, I'm talking about only the top 1% of investors in the world know and use this passive income formula. And we're going to be touching on this presentation so that you can walk away from this presentation knowing how to use some of it immediately. Let me start with a story really quickly. Many years ago, I was sitting in a meeting, and around the table were about 8 people. They're all Ivy League graduates, and we're putting a deal together. And this deal was a $50 million deal. And the funniest thing happened. The lady who just finished presenting, she's a Stanford graduate, just talked about how we're going to structure the financing on the deal. So I looked around the table, and everyone is nodding their head in agreement with her. And I looked around and I said, guys, this doesn't work. And let me explain why. And then I went on to explain why it's not the best structure. And I used specific terms, and I could tell I lost people in the room. And so as soon as I did that, there's a gentleman that was sitting right across from me with his laptop open. And this is the only guy in the room that had 2 graduate degrees from 2 different Ivy League universities. And this guy had been putting deals together for many, many, many years, 20 plus years, 25 years. And he said, bingo. I'm like, bingo, what are you talking about? He goes, exactly what you described is perfect. I've been doing this for over 25 years, and I've never had anyone explain it the way you explain it. And you're absolutely 100% correct. So at this point, everyone looked around and were like, wait a minute, what did George just say? Now, the reason is I'm the only one in that room that didn't have an Ivy League degree. And so what happened is I had to go back and explain what I just said, and then they got it. Now, the reason for this story is this. The information you're about to learn is extremely advanced, and a lot of people, when we say you're going to learn how to structure these like the top 1%, you'll find out that truly the very top of the top experts out there know this information. And you'll be learning this a little bit today, and then we're going to be talking about how you can start using it. So with that, I want to start with a few things. I get a lot of people walking up to me in different events and stuff like that and saying, I'm an investor, I've been an investor for 10, 15 years, but they have nothing to show for it. I believe that most people that call themselves investors are just bouncing all over the place, and they have nothing to show for it. They're just wasting their lives. And I'm saying that because my mentor, whose net worth is quite a bit, always told me there are a lot of people out there, all they do is they bounce around from one thing to another, and they have nothing to show for it after 10, 15, 20 years. And it's such a true statement. In fact, I hear people out there talking about how they've raised millions of dollars. And in fact, one specific story that comes to mind is I met this person in some event, And he had raised $1 million from his friends and family and lost it all within 2 years in real estate. How would that feel? Losing $1 million of your friends and family's money. And so I feel once again that a lot of people out there are just bouncing all over the place, wasting their lives. Now, it turns out that there is a formula that applies that can help you structure deals a lot safer and make a lot more money and get to your goals much, much faster. Right now, I see a lot of people, a lot of investors just lost all over the place, bouncing around again. And what we want to do on this call is present to you the formula that you can start using immediately to start generating passive income from any income producing asset. So let me start by who are we and why you should listen to us. So Paul, do you want to start with your background?
Absolutely. Thank you, George. So my background is a long-term background as an entrepreneur. I've started a number of businesses successfully, some not so successfully, but we learned a lot from our mistakes as well. But overall, as a career as an entrepreneur, I've had a tremendous amount of success. I also have a finance degree. I went away to college right out of high school and got a degree in finance. And then pretty much right after college, I moved back to New York, where I'm from, and got involved in real estate. So I spent about 15 years working as a real estate broker and a real estate investor, both residential and commercial. And over the course of 15 years, successfully involved in hundreds and hundreds and hundreds of transactions, again, both on the residential and commercial side of the business, as both a broker and an investor. So that's pretty much my background. I was incredibly successful. Everything that I was touching between the years of 2000 and 2008, literally, it felt like anything that I touched would turn to gold. It was a great time in the real estate market. And come 2008, just like what happened to so many other real estate investors out there, I pretty much lost it all. And through experiencing that level of pain, that level of suffering, from going from being on top of the world to feeling like the whole world was caving in on me, I learned a lot from that experience. And when I came across George and when I came across Impact Wealth and this training, it's what inspired me so much to now be sharing this training with you and with as many people as possible all around the world, because the level of pain that I experienced from losing so much so quickly really has me inspired to make it so that nobody else in the world has to experience that. And I can tell you, from this training, from the Wealthy Code training, you will be able to learn the tools and have the resources that you need to make sure that you don't have to go through the same thing that I went through. So again, that's a little bit about my background and why I'm here and so passionate about sharing this training with you. So with that, George, do you want to tell a little bit about you and about your background?
Sure. Thanks, Paul. So my background is in technology. I worked all the way through 2001 in software and high tech in Silicon Valley. I worked for companies like Intuit, makers of Quicken, Microsoft, and a number of other companies. But in 2001, I walked away from that and I got into real estate. And my background in real estate is I've done, as an investor, apartment buildings, residential, rental properties, and a lot of private lending. And I've raised millions and millions of dollars. Again, I've done hundreds of transactions. And I got to a point right now, so I've been helping other people and training other people since 2006. And I was able to get out of the rat race by 2005. And I've done so many different types of deals. And one of the things that really I recognized is how different types of passive income can be generated from different types of assets, but it's the same formula. And this is the formula we're going to be talking about today. But the best part about this whole thing, I want to just give you guys a hint, is at the very, very end of this presentation, there's an incredible surprise. So make sure you stay till the very, very end, because there is a shocking surprise that you will all be glad you did. So make sure you hang in there till the very end, because we're pretty excited about the surprise at the end. So anyway, so basically, we practice what we preach. So why should you listen to me and to us? I could tell you that I'm the author of 2 best-selling books, The Banker's Code and The Wealthy Code, but you know what? Who cares? I could tell you I've been the radio host on Wall Street Radio Network, but you know what? Who cares? I could tell you my company made Inc. 500 2 years in a row, but you know what? Who cares? I could tell you I'm the founder of the largest network of private lenders in the world, but you know what again? Who cares? Here's why you should listen, and here's why you should care, because this information can be the difference between success and failure in your investing. I promise you this. The information in this training can be the difference between success and failure. And a lot of people that have gone through this training have told us this is one of the best trainings they've been to. And I'll tell you that even just from the webinar, you're going to learn so much. So with that, are you guys ready? I hope so. So let's jump in and start with the agenda for the training. We're going to cover everything here on the agenda. Now, typically this training is done in a live setting, and it's extremely interactive. And we get people to the front of the room and we do different things. However, given that this is a webinar and it's the first time we're doing as a webinar, a lot of these interactive exercises we do won't be possible. And so there's an item there on the agenda, class exercise, that we will obviously not be able to do. And if anyone comes to the live training to see this, they'll get to go through this. However, for now, let's do our best in making sure we give you all the valuable content that you guys can use immediately. So Paul, do you want to start with the deal section?
Okay, so now I'm going to tell you about the deal. So before I do, let me just remind you that what we're covering here on this training it applies to any income producing asset. So this is going to teach you how to generate passive income from any income producing asset. However, since most of you are probably real estate investors, since this is for a real estate investing club, we're going to put a picture of a home or a house on here for you because we want you to feel nice and cozy. So we know that you're used to thinking about income producing assets as real estate, as property. So that's why we'll put this picture up here so this way you can feel at home. So this is the deal. So you go out and you find this great income producing asset. So you're looking for a long-term 10-year buy and hold for income property or asset, and you find a great income producing asset. It costs $100,000 to purchase it, and you want to structure this deal to be as safe as possible for passive income. So with that, on the screen, you see 5 different options for a loan, and this is for an 80% loan to value. So it's very traditional, very standard, 20% down payment, 80% loan deal. So from loan options A through E, I want you to take 30 seconds and just look at these different loan options, and on a piece of paper, just write down which of these loan options would you choose, would you pick, and again, in order to structure this as the safest deal possible. So go ahead and take 30 seconds.
Well, I set up the stopwatch, so make sure everyone gets 30 seconds. So we're going to be quiet for 30 seconds. 10, 15 seconds, 20 seconds. Once again, folks, you want to write A to E, one of the letters. 27 seconds, 30 seconds. Let's give them another 10 seconds. 40 seconds. So let's just give them another 10 seconds. So right now, folks, you should be trying to figure out which one is the best loan in terms of safety for passive income, A to E. Four more seconds, 3 more seconds, 2, 1, 0. So we give you a whole minute, okay?
So again, that was for the loan portion of this deal. So now on the screen, you see that there are 6 different options for your down payment. So just like we did for the last piece, take a minute, look at all of these options, and on your piece of paper, write down either number 1 or number 2, 3, 4, 5, or 6. Write down one number on your piece of paper, go through these, and pick, again, the best down payment option for this to be the safest deal possible for passive income. So we'll give you a minute to do that, and go ahead and do that now.
So I started the counter. 10 seconds. seconds. So again, just pick numbers 1 to 6. Just pick one number for a down payment. 30 seconds. $40. Again, you're picking the down payment here. You already picked the 80%. All you're doing is picking the best 20% down payment. 8 seconds left. 7, 6, 5, 4. Okay, 1 minute's over. You know, Paul, one of the interesting things that whenever we do this in a live event, what's really interesting when we have a room full of real estate investors, we end up getting every single combination. There are, I think, 30 combinations between the down payment and the loans, and we end up getting every single combination, A to E and 1 to 6, every combination.
Every single time, right? No matter where we are in the world and the country, every single time we get every single option, right, George?
Yeah, let's talk about what's the problem with that so people get it.
So the problem with that is in rooms full of real estate investors that, again, are classifying themselves as real estate investors, professional investors, they can't come to a consensus on this incredibly simple 80% loan, 20% down payment deal on how to structure it the safest way for passive income, which is why so many people are out there losing their shirts and have lost their shirts in the past and continue to go out and make mistakes and put themselves into deals and put other people's money into deals that are not safe and where their money's at an incredibly high risk. So that really is the problem with this, is that everybody should be able to look at these two options between a down payment and a loan, and within a really short period of time, very quickly be able to pick out which is the best down payment option and which is the best loan option, which does not happen anywhere we go.
And you know what, Paul? These people's families and friends are depending on them. They're putting money with them because they expect them to know the answer to that. So that's what really is shocking. So with that, we're going to be revealing the answer at the end of the presentation here. In fact, we're going to have you come up with the answer. Through the training, you're going to all figure out the answer, and you're going to understand how to calculate it and how to come up with the right answer. So before we move on to the next section, Paul, anything else you want to add?
No, just to say, and I think you just mentioned this, George, but we will give you the correct answers to both of those questions at the end of this webinar. So again, make sure you stay on till the end so you can find out what the right answers were.
Excellent. We just completed the deal section. Now we're going to talk about the problem. The problem is, what problem do you have with passive income? Now, there are a number of challenges out there, but one of the big ones is, which income vehicle do we pick? There are many options out there. You've got apartment buildings, you've got office rental properties, storage, businesses, you name it. It's all out there, and you see a million websites out there that talk about passive income. So before we talk about that, let's talk about this book, Outliers, which is a great book, and I know a number of people on this call have read it. And in the book, the author talks about this 10,000-hour rule, which is it takes 10,000 hours to master something complex like playing golf or buying apartment buildings or storage or whatever it is. 10,000 hours is equivalent to 5 years full-time or doing something part-time for 10 years. So think about that. It takes you 5 years full-time of doing the same thing to be able to master it, or 10 years part-time at 20 hours a week to master something, whatever it is. Now with that, the problem we find is that a lot of people jump from one vehicle to another, trying them out with very little to no success. Why is that? Because they need 10,000 hours to master that one single vehicle. With that, the question is, what if you pick the wrong vehicle? So let me explain that. You pick one of these vehicles, you master it, you put all the effort and energy for 5 years or 10 years, and then after 5 or 10 years you realize, oops, this was the wrong vehicle. And then you decide to pick a second vehicle, and once again you invest another 5 to 10 years just to find out it was the wrong vehicle. How would that feel? it turns out that there's a passive income framework, and the mistake is that most people pick the vehicle first. They walk up to me, at different events, and they say, "I'm going to do stocks, or I'm going to do rental properties, or I'm going to do whatever it is." They're picking the vehicle first, and that's the wrong approach. The right approach is to start with the result in mind. So there are two results when you're trying to build wealth: cash flow and capital gains. And you really want to have both in your portfolio. But we all know what cash flow is. Capital gains is simply something you buy, you pray it goes up in value, and then you sell in the future. Now, on this training, we're not talking about capital gains. We're just going to stick with cash flow. So you pick the result first. And second is you build the portfolio or the framework. And these are the characteristics, the ideal characteristics you want to have in place to generate cash flow. That's what we call the formula. And so once you build these characteristics, at that point, you can then pick the investment vehicle, because what it does actually is it ends up filtering out most of the vehicles out there, and you end up with maybe 2 or 3 vehicles that you can pick. And that's the right approach. You're starting with the result that you're looking for in mind. You build the right framework, which is what we call the formula, and then you pick the investment vehicle. And most people end up picking the vehicle first, and then they end up finding out many, many years later it was the wrong one. Now, again, on this training, we're not going to talk about capital gains. We're going to be talking about passive income. Now, let's take what I just said and expand that and talk about the formula here. So once again, many people out there read great books like Rich Dad Poor Dad, which is an incredible book. And then out of that, they pick the vehicle. And once again, that's the wrong approach, because the book itself was never meant to be a manual on investing. It was just about mindset. And it did a great job in teaching us how to think like the wealthy, but it never gave us the formula. What you really want to do, like the most sophisticated investors out there do, is they build the formula, and that's what we call the wealthy code. And from there, they end up picking the right vehicles based on the formula, because once again, it filters out a lot of different vehicles. So with that, once you know the formula, once you have the formula in place, you can again apply it to many assets that fit the criteria for passive income. The challenge is most people spend a lifetime trying different vehicles without knowing the underlying formula. And that's why we see people bouncing from one thing to another. Just like when I started, all they're doing is bouncing, trying different things without any specific approach. And the formula itself gives you that approach that we're talking about. So what is the problem we're solving here? The problem we're solving is, how do we structure safer and more profitable deals with the right assets for passive income without wasting time? Without wasting time. We don't want to wake up 5, 10, 15, 20 years from now and look back and realize we've been wasting our lives. And that's the problem we're solving. Okay, so we just completed the problem. Let's jump into the foundation of the formula. Paul, did you want to do this?
Absolutely, yeah. So now we're going to talk about, the foundation of the formula. So what you see on your screen is what we call the top tier investor triangle. On the bottom of the triangle, you'll see that it says structuring deals correctly. And then on the right side, investing in the right assets. And on the left side, raising private capital. So in order to be a top tier investor, you need all 3 of these skills. Once again, you need all 3 of these skills. So let's just presume for a moment that you had 2 of 3 of these skills, and let's see what would happen. So let's say you knew how to structure deals correctly, and you knew how to raise private capital, but you were investing in the wrong assets. What's going to happen if you do that? Naturally, you're not going to be successful. You're going to lose money. You probably lose your shirt if you're investing in the wrong assets. And let's say, another example, if you know how to structure deals correctly, you know the right assets to invest in, but you don't know how to raise private capital. At that point, you may have some success, but your success will be incredibly limited, because it'll be limited to the amount of money that you can invest without being able to raise capital from outside sources. And let's say you're really great at raising private capital, you're really great at knowing the right assets to invest in and investing in them, but you don't know how to structure deals correctly. What's going to happen then? Of course, if you don't know how to structure deals correctly, just like what I can personally attest to, what happened to me and so many other investors back in 2008, you will lose your shirt. So once again, you need all three of these skills in order to become a top-tier investor. So what I want to talk to you about now is debt versus equity. So pretty simple, but just to give you what these explanations are. So debt is if I were to lend you money, so let's say I lend you $100,000 as debt, and I'm charging you a 10% interest rate. So if that's debt financing, if I lend you $100,000 at 10%, you would have to pay me back my $100,000 plus the 10% interest, and that would come along with monthly payments. So you would make monthly payments to me, and eventually you'd pay back the $100,000 plus the 10% interest. So that's debt. On the other side is equity. With equity, if I were to invest $100,000 with you, if it was equity, I would become a partner in that investment with you. So you wouldn't be obligated to pay me anything on a monthly basis. I would simply just share in the upside. I would share in the profits of whatever that investment, whatever that deal was. So that's the difference between debt and equity. Debt is like any traditional loan or mortgage, and equity is where you're taking on a partner in your deal. So what I want to show you now is what's the skeleton. So this is on the screen, you see a skeleton. And as we all know, the skeleton in a human body, it provides a supporting structure. So the skeleton is the body part that forms the supporting structure of any organism. In our bodies, it's what holds our bodies up. It's what allows us to have our human bodies in the form that we have them in. That's our skeleton. So similar to our bodies, or really any organism that has a skeleton, every single passive income deal has a skeleton. It has a supporting structure for that passive income deal, which is the same for every single passive income deal. And the components of that deal structure, of that supporting skeleton for every passive income deal, if you see on the screen, you see every deal has leverage, every deal has a spread, and the red squiggly line you see going across the middle is income and income volatility. So this is what forms the supporting structure of every single passive income deal that you could ever do, no matter the asset. So you see that there are, on the bottom you have these deal dials. So on the left-hand side, the deal dial is leverage, and on the right-hand side, the deal dial is spread. What we're going to show you is how you can adjust leverage and adjust spread. So those are your dials, and as you adjust leverage and as you adjust the spread, it will impact the return and the risk. So on the top, you see return and risk, and those are gauges. Similar to, I want you to picture this. Imagine you're in a car, you're driving a car. And as you press down on the gas pedal, when you press down on the gas, it's going to impact and affect how the dials, how the gauges read for your RPMs and for your speed, for your miles per hour. So again, you press down on the gas, and your RPMs and your speedometer are going to change based on how hard and how fast you press down on the gas. Well, it's really similar with this. So as you change your leverage and your spread dials, that's like pressing down on the gas. And as you do that, when you change leverage and spread, it's going to impact what's shown on the gauges for return and risk. So we'll be showing you as we move forward with the training how you can shift and change leverage and spread to impact your return and your risk in any passive income deal. So again, what you see now is the basic deal structure skeleton. So you have the leverage and the spread knobs, and on top you have return and risk. Those are your gauges, and the components of the deal are leverage, spread, and again the red squiggly line is income and income volatility. So we're going to be using this diagram that you see now throughout the training, and showing you what happens if you adjust leverage and adjust spread and how that impacts your return and your risk. So once again, that's the foundation of the formula. And now I'll pass it over to George, and George will tell you a little bit about what is the spread. So George, take it from here.
Thanks, Paul. So let's talk about what is the spread. So we talked about this dial called the spread. Let's talk about it. So what I want you guys to imagine now is you're walking into a retail store. For example, think of Target, okay? You walk through the sliding doors open, and you see right there in front of you on a table these black boxes. And these black boxes generate $100 cash flow every single month. So you buy this thing, you put it on your shelf, and every month it cranks out $100. Now this black box costs you $12,000, and you can buy as many of them as you want. But you don't have the $12,000. So what then you decide to do is you find your uncle who has the $12,000 sitting in the bank account. Let's just call your Uncle Brett, for example. So Uncle Brett is sitting there with a whole bunch of money and making no money in the checking account. So then you convince your Uncle Brett to go ahead and to lend you the money, the $12,000, and you pledge the black box as collateral, and you agree to pay him $50 a month. So now the black box, so you buy this black box, you put it on your shelf, and it pays you $100 per month, every single month. And then you turn around and you pay your Uncle Brett, in this case, $50. So you're left with $50 in your pocket every single month. Now, on the left-hand side, the black box, and we use the black box on purpose here just to remind you that this works for any income-producing asset. This asset, this black box is the asset, and once again, it could be any income-producing asset. And on the right-hand side, you've got leverage. Now we have the foundation of what we call a wealth bear. You've got on one side an asset, and the other side leverage. And again, remember the asset has to be income-producing asset. And so this is what we call a wealth bear. It has two sides. Okay. Now let's expand that, and I'm going to introduce a new metric right now. In fact, two new metrics. So make sure you write these down. So again, you have an asset on the left-hand side and leverage on the right-hand side. Now, in this example, the asset's paying you 10%, and then you're paying your money source 6%, so you're left with 4% spread in your pocket. That 4% is what goes into your pocket and generates passive income. However, what you have to realize now is what is that 6% and what is that 10% called? And so the 10% is actually called a cap rate or capitalization rate. And I don't want you to worry about the exact meaning and all that stuff. Just remember this. The cap rate is nothing more than a measure of the net income for coming from the asset. That means after paying expenses and all that stuff. So whatever the net is, in this case it's 10%. And then on the right-hand side for the leverage, you have something called a loan constant. And a loan constant is a measure of the payments, the principal and interest, going towards leverage. So don't worry again about the exact meaning. Just think of it as a measure of how much is going out from your pocket. So on the left-hand side, you have 10% coming in from the asset. That's a cap rate. And on the other side, you've got 6% going out. Therefore, you have 4% spread. So for a wealth bear, what you want to do is you want to maximize that spread. That's the spread we're talking about and that Paul mentioned earlier. You want to maximize that. So you want to maximize the cap rate and minimize the loan constant. And typically, you have more power or more flexibility on the loan constant than the cap rate. And so now you end up with this wealth bear. And so remember these terms, cap rate and loan constant. So in a nutshell, you always ask yourself, whenever you have an asset, what's the cap rate from the asset? And then whenever you have leverage or borrowed money, ask yourself, what's the loan constant? Because the spread in the middle is what puts money in your pocket. Now, a very common problem is that a lot of people look at the interest rate on the leverage or on a mortgage. That is the biggest mistake. You cannot just look at the interest rate. In fact, that's precisely the reason, one of the many reasons, that people lost their shirts in 2008 is because they were being given the lowest interest rate loans. And that's what caused a lot of problems. You'll find out that you have to be looking at the loan constant. So here's a key lesson for module number 1. Now we're just going to touch on 2 modules in this training. There are many, many modules we do in the live training, but we want to make sure we give you the first 2 lessons. The first one, to generate a spread, you need 2 sides. You need an income-producing asset, and you need leverage. The cap rate, which comes from the asset, it must be larger than the loan constant, which is from the leverage. So the difference between the cap rate and the loan constant is the passive income that goes into your pocket. That's the key lesson for number 1. So in a basic deal structure, when we looked at this deal earlier, where Paul was talking about it, he said for the skeleton, you've got leverage, you've got spread, and you've got the squiggly line, which we won't talk about in this training. Let's now focus on spread. So the spread is nothing more than the difference between the cap rate and the loan constant, and you want that to be the widest spread possible. So what we're going to do now is, normally in a live training we give out a sample deal worksheet, but obviously we can't do this on this training. But we're going to go back to the question that Paul asked earlier, and he asked, what is the best loan between A and E, the 80% loan, and we give you a minute to find that loan. So what we're going to do now is we're going to give you the options again, except now we're going to help you with the answer. Now, initially we didn't give you the loan constant, but what you want to do is pick the lowest loan constant in order to maximize the spread. And so here are the loan constant and here are the loans. So this is what we gave you earlier, but what we just added in here are the loan constants in red. So once again, what you're trying to do is, in order to maximize the spread, you want to minimize or pick the lowest loan constant. Now look at the screen and tell me, which do you think is the lowest loan constant? That is correct. So the answer is C. Loan option C is the lowest loan constant. Now, typically we go into more detail in a live setting because we show you different things. However, in this case over webinar, it's pretty restrictive. So just realize that the loan constant is also a measure of risk. The lower the loan constant, the safer the loan. The higher the loan constant, the higher the risk. Now, why do I say that? Now, I want you to look at the interest rates, which is on top. Okay, and I want you to tell me which loan has the lowest interest rate. Obviously, that's loan A, 4.2%. It's the lowest interest rate. Now, at the same time, what I want you to do is tell me which one has the highest loan constant, which is the highest risk loan. And it turns out to be the same loan option. Now, here's the lesson here. Interest rate by itself doesn't tell you much. It just tells you the cost of money is low, but it also tells you, in this case, the highest risk loan to get as an investor is loan A, because it has the highest loan option. Now, look at the interest rates again and tell me which one has the highest interest rate among the top row here. You'll notice that C has the highest interest rate. Which one has the lowest loan constant, meaning it's the safest loan? Obviously, it's C again. So what's the lesson there? The lesson is this. Don't just look at the interest rates. You want to pick, as an investor, the lowest risk loan, and it just happens to be, in this example, the highest interest rate, but it's the lowest loan constant. Folks, that's why people have lost their shirts in 2008, 2007. One of the many reasons is because they were picking the lowest interest rate. What people didn't realize at the time is it wasn't the best loan constant. So in order to, once again, maximize your passive income, you want to pick the lowest loan constant. So that is the lesson for this section. What is the spread? Now we know what it is. Let's move on to the next section, which is structuring the down payment. So with that, let's talk about the three main components to passive income deal. Now earlier we talked about a wealth pair is two sides. On one side is your asset, and then on the other side is the money part. So the money part here is broken up now into two pieces, down payment and leverage. This ends up giving us three different components for a passive income deal: the asset, the down payment, and the leverage. Now we just covered the difference between the leverage and the asset, the cap rate and the loan constant. Let's talk about now the down payment. So the question is, what is the best structure for the down payment? Now there are three possibilities. The first option is you're using your money. The second option is finding an equity partner. We talked about that earlier, which means someone putting up the money and they're getting a piece of the action, but you have no obligation to pay them any interest rate. It's only part of the profit. And the third option is debt financing, meaning you borrow the down payment. The question I have for you is, which one is the safest and which one is the highest risk. And what I'd like you to think about is put them in order from the safest to the highest risk. So take 10 seconds to do that. So it turns out that this is the order, from the safest to the highest risk. The safest one is actually finding an equity partner, followed by your money, and followed by the highest risk is actually debt financing, or borrowing the down payment. Now here's what's interesting. Guess what most people did in 2008? They borrowed the down payment. If they had done equity financing, most people would have been able to save their properties. Now, some people might say, I've had partners and I hate partners. Well, I'm not talking about the legal aspect of fighting with partners. I'm talking strictly financing here. In terms of financing, having a partner that shares in the downside and the upside with you is actually the best way to go in terms of risk, because that minimizes debt. And the other part then is your capital, and followed by a third one, which is the highest risk, debt financing. I would avoid debt financing for the down payment, because that puts you in a lot of risk. So let's look at this example here. Let's just say you have a deal paying you 10% cap rate, and you're comparing the down payment options. You've got two of them. Once again, this is for the down payment, not for the leverage. Which would you pick? Would you pick Sam, who's willing to put up all the down payment in exchange for 50% of the profits? Or would you pick John, who's willing to lend you all the down payment, but wants an 8% loan consent? Now keep in mind here, we're not talking about interest rates, we're talking about loan consent. So obviously the answer, the best way is to structure with Sam to be a 50% partner, because it lowers the risk. So what's the key lesson for module number 2? Once again, we're only touching on 2 modules in this training. And I want to remind you, there's something at the very end of this presentation that's going to blow your mind. Make sure you stick to the end, because you're going to thank us, okay? A key lesson for module number 2 is the safer way to structure a down payment is to use an equity partner, Again, in the live training, which is multiple days, it's 2 days. It goes for, we talk about many other modules, not just 2. So what's the deal structure look like right now? Once again, the deal structure is sort of your skeleton, like we talked about earlier, where you have spread, leverage, and the squiggly line, which we won't talk about in this training. So the spread we talked about is the cap rate and the loan constant, and the way you lower the leverage is by having an equity partner down payment, okay? So once again, we're just putting the foundation here of any passive income deal, and this is not specific to real estate. We have people that have paper in a filing cabinet that generates passive income. We have people doing all kinds of passive income from different assets that not necessarily real estate. Now, real estate is great to have in your portfolio, and we're big advocates of real estate, but also for some people, they like to have different types of assets. And again, this applies to any income producing asset. That's why a lot of our students have a lot of big filing cabinets, because they end up putting a lot of paper in there for passive income. So let's go back to the first exercise that Paul asked you about, and he gave you 2 different scenarios. One was picking the loan, which we just completed, and the second scenario was picking the down payment, and he gave you 6 options. So here's what Paul showed you earlier. He said pick the best down payment. So why don't you guys look at the screen right now, and you've got 6 options. Tell me which one is the best option given what we just learned about down payments. Once again, you're picking the safest 20% down payment. So obviously the answer is option 6, which is 50%. And once again, when we pick 50% here, it's just an example. It could be 40%, it could be 30%. That's not the issue. The issue is, or the key point here, is that you want to structure it as an equity partner. Now, typically in a live setting, everybody ends up picking the right down payment and the right loan. Now, early in the class, when we give you an option of picking the down payment and the loan, there were 30 different combinations. And like I said, and like Paul said earlier, we end up having every possible scenario picked. However, once you learn just 2 modules, simple modules, these are actually the simplest modules in the training, the easiest ones, we end up having everybody agree that number 6 is the best down payment, and the letter C, as in Charlie, is the best loan. And they have this incredible sense of empowerment that everybody in the room, as real estate investors, now understands what's the best loan combination. Now, here's what's interesting to me is how many more things are these real estate investors and everyone on this call not agreeing to? And what you realize is that everything we're talking about here is finance. It's strictly finance. And real estate is nothing more than a financing game. And you cannot just start doing real estate investing without understanding the financing game. And that's what we're talking about here, folks, is understanding how to pick the right financing for the job. So we just completed the next section, structuring the down payment. Now this next exercise, next section here is typically where we have everybody come to the front of the room and we give them a new deal, and then they have to structure the deal as a whole class. The whole class ends up doing it together, and they end up coming up with the same exact result. And again, that is so empowering because we just spent less than an hour with them and they already know how to structure deals. But there are many more questions. For example, how much leverage should you have? How much risk? You have to put a number to risk. We see this all the time where people are looking at the returns. I hear people pitching, oh, I'm going to make 12% return, I'm going to make 15% return, I'm going to make 20% return. But what is the risk that corresponds with that return? And so one of the things we do in the training is we put a number to risk. So imagine having, for example, 15% return with a high risk number. I'm not going to give you a number right now, but let's just say it's a high number, versus 12% return with low risk. So you have to look at risk as well. And we just talked about two modules here, how to minimize risk, but also you have to be looking at more things, and this is all basic finance. So let's go to the conclusion here. Paul, did you want to do the conclusion?
Yeah, sure. I'd love to cover the conclusion. So just to go over and summarize what George just shared with everybody. So again, we have the top tier investor triangle. So the three parts, the three components of this top tier investor triangle, which again, everyone needs to have all three of these components in order to be a top tier investor. So at the bottom, you have structuring deals correctly, and then you have investing in the right assets and raising private capital. So what we started touching on in this webinar and what we'll be covering in incredible detail at the two-day workshop will be how to structure deals correctly. This is the wealthy code. So once again, all three components of these are needed to be a top tier investor. And then we have the basic model for passive income. So on the left-hand side, you have an income producing asset, and the income producing asset will give you a cap rate, which is a measure of your net income from that income producing asset. And then on the right side, you have your financing stack, which is made up of your down payment and your financial leverage, or a loan that you will take to buy that income producing asset. So again, the down payment, the safest way to structure the down payment is by bringing on and using an equity partner. The second safest way is using your own money. And then the financial leverage piece, you want to measure your financial leverage with a loan constant, not with an interest rate. Again, how so many people lost their shirts and have failed over and over again with investing in income producing assets is by using the interest rate and not the loan constant. So with leverage, you always want to look at the loan constant. So again, that's the basic model for passive income. And then we talked about wealth pairs. So again, the income producing asset and your loan constant so you have an income producing asset and leverage, and those two components is what makes up a wealth pair. So you want to have, every investor wants to have a portfolio of as many wealth pairs as possible. These wealth pairs can come from income properties or a business or private lending. There are a lot of different ways that you can create wealth pairs, and every successful investor, every top tier investor wants to have a portfolio balanced with and filled with tons of different wealth pairs. So once again, the goal is to have wealth pairs, various assets, generating passive income, and structured to be low risk and as hassle-free as possible. The goal here, my friends, is create income, create wealth, while not putting your money and your investors' money at risk. So do it in a safe way where you're guaranteed to get to your goal and guaranteed to get to where you want to get to with your life and with your investing.
Excellent. Thanks, Paul. So we're going to do now the importance of receiving the right training. Now, I get this all the time. You know, whenever I'm speaking in different places, I get people from different trainings. They come up to me and they say, I just took this so-and-so training over here or so-and-so training over there. Am I stupid? I'm not getting it. And that's really funny because really, we have a funny slide here, but really the topic is very important to us. And the question isn't, are you stupid? The question is, are you getting the right training or even the wrong training? See, there was an article by Time magazine and it talks about why long lectures are ineffective. And one of the things we do when we do these trainings, we are big proponents of active learning, not passive, but active learning. Now, many of you might have seen this. It's called the cone of learning. And here's what is known. People generally remember only 10% of what they read, 20% of what they hear, 30% of what they see, 50% of what they see and hear. Now, the top 50% is the passive learning side. What we focus on is the active learning side. And let's go over that. 70% people generally remember 70% of what they say and write, 90% of what they do. Now, a lot of our training, we're doing stuff. We're not just lecturing. Unfortunately, on this webinar, it's very hard to portray that, but all our trainings are very, very active learning. We don't do boring lectures. We do experiential training. In fact, if you look at the slide there, you'll see a lot of colored cards. We do a lot of playing games, but we're actually doing real stuff, real games, real deals. We do a lot of role playing. We do fun training. We do group exercises. We do active learning. This is our forte. This is our strength. We are the leaders in experiential training for the financial education world. The question you have to ask yourself is this: do you want to learn the fun way or the hard way? That is really up to you. And so we have an upcoming training called the Wealthy Code Workshop in your area. And this is all experiential training. In fact, you'll be structuring deals. On the second day, we'll be giving you deals, and you'll be structuring and presenting it to the whole class. And you'll be blown away by what you can do. Now, here's the best part. And we're keeping this a surprise towards the end. We're almost done. But I promise you this. You will love this. And this is thanks to your REIA, your real estate club. So we'll talk about it here in a second. But before we do that, let me just go over a few testimonies from students that took the Wealthy Code training. Here's Victoria Lau. She says, having come from an engineering background and having some real estate experience, the Wealthy Code has really opened my eyes to generating wealth through passive income. I'm no longer reliant on my job solely for income. I've learned the three most impactful concepts towards wealth building: raising money, structuring deals, and placing money in those deals. I'm more empowered than ever to take control of my financial future. Here's Mavis. The Wealthy Code allowed me to understand the key drivers that produce investment returns. More importantly, it gave me the tools to evaluate deals not just based on return on investment, but also the risk level of each deal. With the knowledge I have after this class, I can structure deals at a risk profile that matches my investors' risk tolerance. Overall, it's a great foundation for anyone who's looking to build wealth through financial instruments. And one thing I liked about Mavis's testimony here, she said financial instruments. Again, this applies to any income-producing asset. It's not just real estate. Here's what Brett say: I'll never look at deal structuring the same. Things that I thought were making my deals safer or more profitable were in fact making my deals riskier and less profitable. This truly is a much-needed foundation for any business owner or investor. Here's what Darcy said. We have so many of those testimonies, but I'll just read a few more. The Wealthy Code should be a requirement for any new investor, no matter what the investment vehicle. She goes on and on and on. Michael Harper, attending the Wealthy Code has given me the confidence and prepared me with the tools to analyze any financial investment opportunity like a seasoned investor. With this information, I'm able to structure any type of deal, regardless of its size or type. I love it. So the question is, do you want to let another 10 years of mistakes pass you by before you figure out that you need to master the passive income formula? I want to go back to what I said earlier. There are many people bouncing all over the place, calling themselves investors, and finding out after 5, 10, 15 years they have nothing to show for it. Folks, this is the missing formula here because it works for any passive income deal. And you'll be able to use this information to structure safer and more profitable deals. Think about it this way. How many deals would you structure and do if you knew that you're covering your downside? You're making the deal a lot safer. That's why a lot of people are so scared, because they're so scared of losing other people's money. We show you how to lower the risk significantly and cover the downside. Imagine being able to have this much detail. I'm going to give you here some deals and look at the detail. Now imagine structuring a deal and having the return to be 12%, but the risk to be very high. Now, instead of very high, typically when you walk out of the wealthy code, you'll have a number there. It's a number, but because you haven't learned that, I'm just going to use very high to explain risk. Imagine having a 12% return and the risk is very high. Would you do the deal? Hopefully not. What if you can adjust those dials we talked about, leverage and spread, and just adjust them a little bit here and there, and you end up getting an 11% return with a low risk profile on the deal? Would you do the deal? Obviously, this would be a much better deal. Now then you decide, let me adjust those dials again. Let me see what happens. You adjust the dials a little bit more left and right, and then you end up coming with 12.5% return with still low risk. How would that feel? Excellent, right? And then you decide to adjust it a little bit more, and you end up with 12.2% return and a very high risk still. So then obviously you're not going to do that deal. You're going to go back and do the other deal, the 12.5% low risk. But you see, folks, here now you have the tools to be able to adjust those dials and come up with the right return and the right risk profile for you and your money partners. This is what makes this so powerful. Now, again, instead of having the word low risk and high risk, you could actually have numbers. You could have a risk scale so you know what you're comfortable with so that you can put the deal together. This is how empowering this training is. So let's talk about next steps for some of you on the call here and an opportunity to become a top-tier investor. Now, this training, we haven't given you the surprise yet. There's a surprise that's going to blow your mind here, and you've never, ever, ever seen it on a webinar like this. I promise you that. So this workshop is a hands-on and very, very interactive workshop where you learn step-by-step formula for generating passive income. I promise you this is going to blow your mind away. Why? Because we get to play games, and the whole 2 days is nothing more than just having fun and very interactive. And like I said, on the second day, you're going to be structuring deals and presenting them. On the first day, you're going to be competing with other teams and winning awards and stuff like that and beating other teams in a game we do. But there's so much learning going on there. In fact, our bold promise is this. By the end of the 2-day Wealthy Code workshop, you will be structuring deals for passive income like the top 1% of all investors in the world. Now that is one big, bold promise. And you'll find out when you walk out of that 2 days that you will be indeed structuring deals like the top 1% of all investors in the world. You will be blown away by the new language you use, the new terms you use, the new tools, the new calculators, the new spreadsheets, and how you think. It'll blow your mind away.